Okay, we are currently witnessing one of the most massive, absolutely foundational economic shifts in modern history. Welcome to this explainer. Today, we're unpacking the hard data behind a structural realignment where a historically unprecedented trade dispute has triggered a staggering global repositioning of capital, alliances, and resource dominance. Let's dive right in. So, what actually happens when the greatest economic partnership in human history literally ends overnight? Before this realignment, the United States and Canada were exchanging over $760 billion worth of goods and services every single year. To put that into perspective, that's larger than the entire GDP of many developed nations. We're talking more than $2 billion crossing the border every single day. Generations of workers and businesses built their entire livelihoods assuming this deeply fused partnership was permanent. But, well, that foundational assumption was just completely shattered. Section 1. The trade partnership collapses. Let's look at exactly how fast this historic unraveling occurred. The foundation of North American trade was uniquely complex. It's like a giant puzzle. The US-Canada auto industry wasn't just two countries trading finished products back and forth, right? It was a shared circulatory system. The supply chain was so heavily integrated that a single car built in Detroit crossed the US-Canada border up to 8 times before it was even completed. Parts forged in Michigan, shipped over to Ontario for assembly, brought back for American steel integration, and finally finished stateside. You simply cannot surgically cut one side of a supply chain like this without immediately amputating the other. But in early 2025, sudden sweeping tariffs hit. In February, the US imposed 25% tariffs on virtually all Canadian imports, and Canada didn't even blink. Within hours, they announced $30 billion in retaliatory tariffs. Then, in March, the U.S. enacted the nuclear option, 25% tariffs on all imported vehicles and auto parts. This completely amputated that deeply integrated supply chain we just talked about, sparking multi-billion-dollar retaliations that fundamentally rewrote the map of global trade in a matter of weeks. Moving to Section 2, America's $40 trillion debt. Because, this trade war didn't happen in a vacuum. It happened during a moment of historic fiscal vulnerability. Side by side, the math tells a really sobering story. Following persistent deficits, Moody's officially stripped America of its last remaining top-tier AAA credit rating, downgrading it to AA1. That means borrowing just got a lot more expensive for America. The U.S. deficit to GDP ratio, which is essentially how much a government borrows compared to what its entire economy produces, sits at a staggering 5.8%. Meanwhile, Canada maintained its elite AAA status globally, backed by a much lower ratio of just 1.9%. Institutional investors and massive sovereign wealth funds run these numbers every day, and capital, predictably, flows toward the more fiscally responsible partner. And this vulnerability, it's compounding rapidly. America's interest payments alone have nearly tripled in just 5 years. In 2020, it cost $345 billion to service the debt. By 2025, it nearly reached $1 trillion, hitting $970 billion. And get this, the Congressional Budget Office projects that by 2036, the U.S. is going to spend $2.1 trillion per year purely on debt interest. By 2048, interest actually becomes the single largest expenditure in the entire federal budget, completely swallowing up critical funding for things like Medicare and national defense. So the absolutely crucial point here is the sheer velocity of this cost. Right now, the U.S. government pays an astonishing $33,000 in interest every single second. Think about that for a second. When the economic giant next door is running incredibly high leverage and losing its top-tier credit rating, the stability of its AAA-rated neighbor suddenly becomes extraordinarily valuable to investors looking to protect their assets. Which brings us to Section 3, Canada's global alliance pivot. Faced with a volatile and heavily leveraged U.S. market, Canada made a major move. Following those devastating auto tariffs, Canada launched an unprecedented strategic pivot away from American reliance. The newly installed Canadian Prime Minister, Mark Carney, declared that the historic economic integration with the United States was officially over. He stated flat out, "We are masters in our own home." And to really hammer this new era home, for his very first foreign trip, he skipped Washington entirely and flew straight to Paris and London to deepen economic ties over there. While Washington was deeply focused on tariff battles, Ottawa spearheaded a massive new alliance. Canada quietly engineered the first-ever trade and investment dialogue, linking the 27-nation European Union with the 12-nation CTPP. That's a major economic bloc, including powerhouses like Japan, Australia, and the UK. Think about the sheer scale of that. Together, this alliance represents roughly 40% of the entire global GDP, encompassing 1.5 billion consumers. They are actively building a parallel global trade architecture, and for the first time in modern history, the US has absolutely no seat at the table. Section 4. The Great Capital Exodus. This structural shift has triggered a quiet but massive flight of global capital. For decades, the US enjoyed an extraordinary economic privilege. They could borrow virtually unlimited money because foreign governments eagerly bought US treasuries as the ultimate safe asset. But since 2008, foreign ownership of US treasuries has collapsed from nearly 50% down to just 30%. That represents a $3 trillion shift quietly walking out the door. Why does this matter? Because when foreign buyers stop stepping up, the US government has to look inward to fund its massive debt, which has some pretty severe domestic consequences that we'll get to in just a minute. Massive sovereign holders are fundamentally retreating. China quietly reduced its U.S. debt holdings to a 17-year low of $682 billion. Meanwhile, Japanese investors are facing rising yields at home, so they're staying there. So where is all this sovereign wealth actually going? Right next door, in just the third quarter of 2025, Canada absorbed a massive $40.6 billion in foreign inward investment. On top of that, Canadian provincial offshore bond issuance hit an absolute record of $57.5 billion. The exact same global investors stepping back from U.S. treasuries are aggressively stepping towards stable Canadian bonds. Section 5. The New Resource Superpower. Let's look at exactly where this rotating global capital is finding a highly lucrative new home. Fleeing dollar volatility, central banks and institutional investors are surging into historical safe haven alternatives, specifically gold. Gold priced in Canadian dollars rose over 57% in 2025 alone. And as the world's fourth largest gold producer, Canada is uniquely positioned to reap those rewards. In the spring of 2025, Canada's gold exports to the UK skyrocketed by an incredible 473%. This isn't just some random market fluctuation. It's a calculated response to global de-dollarization as major investors seek safe harbors. Furthermore, Canada has completely rewired its energy maps. The newly expanded Trans Mountain Pipeline is now sending crude oil directly to Asian markets at a massive scale, totally bypassing the traditional U.S. market. Beyond oil, Canada is right at the center of a global scramble for critical minerals like lithium, copper, and cobalt, the exact materials fueling the future of energy and tech. With over 200 operating mines, sovereign wealth funds are pouring billions into Canada to secure dependable supply chains entirely outside of U.S. jurisdiction. Finally, Section 6, what this means for you. Because, this isn't just high-level macroeconomic theory for central bankers. This hits home. These massive macroeconomic shifts hit your wallet directly. Tariffs are essentially a tax paid by domestic importers, which means production costs at your local car dealership climb higher, pushing those costs straight onto you, the consumer. American farmers who spent generations building export models are suddenly locked out of their most accessible market. We're even seeing this bleed into national defense. Canada actually placed its massive contract for American-made F-35 fighter jets under review, signaling a very real shift toward transatlantic military procurement. But the most severe and immediate shock, that's in your borrowing costs. Because foreign demand for U.S. debt is falling so sharply, the U.S. Treasury has to offer higher yields, meaning higher interest rates, just to attract domestic buyers. Those higher yields instantly ripple out to price the everyday financial products you use. Based on independent analysis, just a 55 basis point rise, that's just over 0.5%, adds $130,000 in lifetime interest costs to a $1 million mortgage. The global retreat from American debt is literally coming directly out of domestic household budgets. So the data clearly shows the world's reserve currency has begun to lose its traditional safety premium, while historically stable trade and defense alliances are being completely rewired. I'll leave you with this final thought. If the global financial architecture is quietly resetting right now, and a 40% global GDP coalition is building a future without reliance on the US dollar, how are you positioning yourself for the aftershocks? Think about it. Thanks for joining us for this explainer, and we'll see you in the next one.